What's up, you guys? Welcome back to the Average Joe on Money Financial Channel, and in this video we are talking Vanguard versus Fidelity. More specifically, we're talking Vanguard index funds versus Fidelity index funds. In a previous video we talked about Vanguard versus Fidelity, but we were talking about exchange traded funds, or ETFs, which is a similar but quite different product than an index fund. And in that battle, Vanguard won. But in this case, we're talking index funds, and I've got a strong feeling it's going to be a lot closer of a battle. In this video, we're going to make sure we're all on the same page on what an indexed mutual fund actually is. And then we're going to break down the differences between Vanguard and Fidelity index funds. We're going to talk about required minimum deposits. We're going to talk about expense ratios. We're going to talk about options between Vanguard and Fidelity. And then we're going to talk briefly about performance between the two different companies as well. And by the end of the video, you're going to have a really strong sense of which company you want to go with if you're going to invest in indexed mutual funds. So is it going to be Vanguard index funds? Woohoo! Or is it going to be Fidelity index funds? And if you already happen to know exactly what an indexed mutual fund actually is, well, don't feel like you have to watch this part of the video just for my sake, though you're open to do that. You can jump right over to this timestamp right here. There we go. And then jump right into the battle between Vanguard and Fidelity. So I don't want to waste a single moment of your time. You clicked on my video when you could have clicked on so many others, so I thank you for that. Let's go ahead and jump right into the content. So what exactly is an indexed mutual fund? Well, let's start with what a mutual fund actually is. A mutual fund is an investment that is created by an investment company. It's created when you pool your money with many different investors around the country and maybe even around the globe to invest in a single type of product. And by pooling your money together, you're able to reduce the cost that it takes to manage this investment. And this investment is called a mutual fund. Now, investing in a mutual fund is a little bit different than investing in a single stock like IBM or Apple or Google, because when you invest in those companies, you decide to purchase a stock for a specific price, let's say $39. And if you buy it right when it's at $39, and that's the price that you get. And that's a lot different than how investing in a mutual fund works. So you see, a mutual fund has a lot of different investments inside of it. These are the underlying investments in the mutual fund. And at any given moment during the trading day, each of these investments are worth a specific price. And it would be very difficult to track that price throughout the day quickly. The cumulative value of all of those underlying investments is known as the net asset value, or NAV. And the NAV, like I mentioned, is very difficult to calculate throughout the trading day at any given moment. So instead, the net asset value is calculated at the end of the trading day each and every day. And that is when you actually purchase your mutual fund shares. So you might be thinking to yourself, hey Joe, if I buy shares of a mutual fund at 8:30 in the morning or 10:30 in the morning, don't I get that price? And the answer to that question is no. If you buy shares of a mutual fund at 9 in the morning, 10 in the morning, 11, whatever time during the trading day, you don't get that price necessarily. You get the price based on the cumulative value, that net asset value of all the investments at the end of the trading day. An index mutual fund is a mutual fund that invests in, well, an index. And when I say index, I'm talking about a listing of specific types of companies. There are many different types of indexes out there. For example, we have large indexes, such as the S&P 500, which is the 500 largest companies here in the United States based on the value of their company. We've also got the NASDAQ, which is a specific index made up of over 2,500 different companies. And then you've also got smaller indexes, such as maybe a sector specific, like information technology or real estate or utilities. And then you have certain indexes based on the size of the company. So we mentioned large ones like the S&P 500, but you also have a mid-cap index and you have a small-cap index. And when I say mid-cap, I'm talking about mid-capitalized or mid-capitalization, meaning just overall the size of the company. The reason why this is important is an indexed mutual fund is very passive in nature. It doesn't require a portfolio manager to make buy and sell decisions each and every day based on what they think is going to happen. Instead, a portfolio manager just needs to track the index, because the goal is not to beat any index, to do better than specific companies, just to do exactly as well as a specific set of companies. And this makes an indexed mutual fund a lot more cost effective for investors because it costs a lot less money to just be passive and track an index. Okay, so now we know what an indexed mutual fund actually is, and you can make the assumption, and I will prove to you, that both Vanguard and Fidelity have a number of different index funds you can invest in. Both have great offerings, and we're going to break down into the details to understand which ones are the best for your specific investment goals and your portfolio. Okay, first thing we're going to look at here between Vanguard and Fidelity index funds is we're going to look at the required minimum deposit or required minimum contribution to the investment company. Vanguard has historically been known as the low-cost index fund provider for the average Joe out there. One of the caveats to owning Vanguard index funds is they have required minimum deposits to each of their index funds. Some of them have a minimum of $1,000 like their target date funds. The majority of them have a $3,000 minimum required investment into the index fund. And what I mean by that is if you're going to start investing in, let's say, Vanguard's S&P 500 index fund, VFIAX, well then, in order to invest in that company, you have to contribute at least $3,000 at the very beginning in order to invest in the company. Now, after that point, you can invest in very small amounts, such as $20, $30, $50 every week or month, depending on what's right for you, but that first initial contribution has to be $3,000. And that can be actually a massive barrier to entry for many average Joe investors out there, people that watch my channel. In fact, there are some Vanguard index funds that you would have to have $50,000 to $100,000 as an initial investment in order to join that investment. Okay, so let's talk about Fidelity index funds now from a required minimum contribution standpoint. Are you ready? Are you sure you're ready? There are none. That's right, all of Fidelity's index funds have a $0 minimum contribution. So if you want to start investing in their S&P 500 index fund, their total market index fund, their mid cap, small cap, doesn't matter. The amount of money you have to contribute at the beginning is $0. So from that perspective, just the required minimum contribution perspective, this has got to go to Fidelity. Fidelity 1, Vanguard 0. Okay, now let's talk a little bit about expense ratios. Just to make sure we're on the same page here, the expense ratio is the cost that Vanguard or Fidelity or any investment company out there charges the investor to manage the assets and the investments on their behalf. The actively managed mutual funds out there can have really hefty expense ratios, sometimes north of 1 or 2% every single year. The great news with Vanguard and Fidelity is they all have very low, super low expense ratios. The majority of expense ratios for Vanguard and Fidelity fall between around 0.03, well actually technically 0%, I'll get there in a second, and maybe as high as 0.12, 0.20. And just to give you an idea of what that looks like, you would just take 0.2% times whatever the value of your investment is. For example, 0.2% would mean that for every $10,000 you have invested, that would be a fee of $20 every single year. It's a pretty low fee when you factor in the value you're getting from these investments, and most of them are much lower than 0.2%. Fidelity launched about 1.5 years ago their Fidelity Zero index funds, and these are index mutual funds that have a 0% expense ratio, which is pretty amazing. They've got 4 different offerings here. I actually made a video a long time ago about Fidelity Zero funds. I'm actually going to do an update video here pretty soon, but just know that there are 4 Fidelity index funds that have a 0% expense ratio, and you can capture the small and mid-sized companies, you can capture international, you can capture large capitalized companies like the S&P 500 with these funds. For the purposes of this review though, I just grabbed 4 different index funds from both Fidelity and Vanguard that are very comparable to see what the differences in the expense ratios are. So first up, we've got, of course, the S&P 500 index fund. For Fidelity, that is FXAIX, and for Vanguard, it is VFIAX. The expense ratio for Fidelity's fund is 0.015%, which is essentially $1.50 every year for every $10,000 invested in the index fund, which is amazing. And then for Vanguard, we've got 0.04%, which is definitely higher than Fidelity. We've also got the small cap and the mid cap, which have the same fees for both Fidelity and Vanguard. For Fidelity, it's 0.026%. And for Vanguard, 0.05%. And then for the International Total Market Index Fund, for Fidelity, we've got 0.035%. And for Vanguard, 0.11%. So for all 4 different examples between Vanguard and Fidelity, the Fidelity index funds had the lower expense ratios. And this is actually pretty much the case all throughout. It used to be Vanguard was the historical low-cost provider. Now it's Fidelity. All right, Fidelity 2, Vanguard 0. All right, third thing we're going to look at here is the offerings of index funds between Vanguard and Fidelity. And this one's actually pretty much a tie. Both Vanguard and Fidelity, as you can see here, offer hundreds of different mutual fund options. The majority of them are index funds with expense ratios very low. So there's no real way to determine a difference between the two. You might find yourself in the unique situation where you maybe have a Fidelity brokerage account or retirement account and you want to purchase a Vanguard index fund, or vice versa. You have a Vanguard brokerage fund, you want to purchase a Fidelity index fund. Question being is, how can you do that if you can, and what are the fees involved in doing so? Turns out if you have a Fidelity account and you want to purchase a Vanguard index fund, well then you're going to have to pay a $75 fee to do so. On the flip side, if you have a Vanguard account and you want to purchase Fidelity index funds, guess what? There's no fee involved as long as you do it electronically and not over the phone. So for the sake of awarding the point for offerings to somebody and recognizing that Fidelity is almost running away with this thing, I'm going to give this point, and maybe it's a courtesy point. I hope Vanguard doesn't feel bad about it. I'm going to give this point to Vanguard. Okay, last thing we're going to look at here, number 4, is the performance of the fund. And the really great thing about indexed mutual funds is that the investments are tracking an index. So it's very straightforward, very transparent, and the investments are essentially equal. If you look here at the S&P 500 index fund between the two companies, pretty much the same performance. If you look at the small cap and the mid cap and the international fund and the dividend funds, they all pretty much have the same performance because they're all based off of the same indexes. The differences here are negligible, so I'm not going to award the point to anybody. It's going to be a tie, which means that we're ending the battle between Vanguard and Fidelity index funds, and the final score, Fidelity wins the index fund battle here in 2020. In the past, I've done videos exclusive to Vanguard and Fidelity for which funds might be perfect for your portfolio, which ones are the best performing during the 2020 recession, things like that. And then moving forward, I'm going to get even more specific. If you're 20 years old, if you're getting ready moving towards retirement, you're not sure which index funds might be the right fit for your portfolio, we're going to do some more specific videos in the future with both Vanguard and Fidelity. So be on the lookout for those videos as well. Now is your opportunity to leave your 2 cents in the comments below. Do you currently own Vanguard or Fidelity index funds right now? If you do, what do you own right now? And if you don't own any of these index funds yet, which company are you going to go with, Vanguard or Fidelity? Make sure to leave your 2 cents in the comments below. So if you haven't done it yet, and how have you not done it yet? Make sure to hit that subscribe button below and click on the notification bell to be alerted to all of my weekly videos. Every week I put out 2 to 3 personal finance videos designed to help the average Joe out there, people like you and me, with all things personal finance, whether it's budgeting, investing for your future, whether it's for income now or for long-term growth, how to pay off your credit card debt, and everything in between. So if that resonates with you, you should consider hitting that subscribe button below and joining the Average Joe Money financial community. The great news for you is though, that even though this video, it's about to end, the learning doesn't have to stop. You can click on these videos right over there.